Let's get the read from former Vice Chairman of NASDAQ, David. Well, we've got Prudential Chief Market Strategist Quincy Crosby and Digital Chairman Dave Maney. Dave, that's my worry, that if this is deemed to be a tough call, then my gosh, what constitutes an easy one?
What you're seeing is the utter breakdown of the two-party system. There's just nobody seems to have any sense of generational stewardship. Everything that Charlie and you both were saying could not be more accurate. The notion that you're going to tag my 6 kids with this astonishing kind of giveaway and you know, at a time when it's so clear that we have the resources and we have the economic strength to be able to pull in those spending reins a little bit is sickening. And there's got to be something that we've got to change in the Washington dynamic, because this is not sustainable. All
right, we'll keep a close eye on the 10-year note, too, that would normally back up on news like this, although maybe Treasury traders are just as sort of resigned to this as our equity traders. But Quincy, I'm looking at this and wondering, I understand the impetus behind this, so let's get over this hump so we can deal with other issues, maybe address immigration down the road, address all this other stuff down the road. But we always do this. There's always another hump to get worried about, another hill to climb, so we can get to that. Right. And when we get to that point, Quincy, we don't address the underlying problems. We just keep pushing them back.
Yeah, it's a process of one Band-Aid after another. And, you know, for the market has done extremely well. But I do think that what has underpinned the market, Neil, is changing. And one of those changes is that deficit, the funding, right, and that 10-year yield. And I think the bond market, with or without central banks, because they're pulling back. You don't notice them coming to the rescue right now. The bond market is going to be able to take over. And if there is more inflation because of all of this, yields are going to climb. That is the way markets work, and already you're seeing it happen. You saw it happen last week. So this is where we are, and again, you've got the infrastructure spending coming out. If that is not a private-public partnership, the question becomes who is going to pay for that. Something that's needed in the country, but really the question always is about the market. And I do think, again, yields are going to have to rise to attract money.
Well,
we're going to have a 10-year treasury.
To your astute point, Quincy, that is exactly what's happening. A 10-year note, the latest quote I have, guys, you can correct me if I'm wrong, is 2.82%. It's backed up 6 basis points. So that has happened just since this accord was reached. So we'll keep an eye on that. I'm not saying the two are correlated here, but I don't see anything else that could affect it here. But that backup seems to be real. Now, David Wild, I'm looking at all of this, and I'm just saying it's the market's way, presumably, of saying, look, so you have no financial backbone. That's not Fox Alert. We've already knew that. Right. But I think when it dawns on them that more Treasury notes and bonds have to be issued to support all this extra spending that could be in excess of $1 trillion, they might be singing a different tune. What do you think?
Well, I mean, clearly we're seeing, interest rates inch up. That's a sign of inflation. We're engaging in more deficit spending, which is going to inflate the economy even more. You know, when investors start to get negative marks on their portfolios of bonds, they're going to start pulling money out of these markets. Interest rates will go up even more. I mean, historically, you reserve deficit spending to pump prime in the depths of a recession, and also when you were concerned about deflation. And right now is the time that we should be, paying down deficits and and we're not doing it. We're not displaying any kind of fiscal restraint whatsoever. And to the point that you made at the front of the show, we are kicking the can down the road to our kids and not leaving them with anything. That's the tragedy.
I'm wondering if the market today, which is well off its highs, I can only imagine this is among the catalysts for that, or simply in fast market conditions, things can and will change very, very quickly. But David Maney, I am wondering now what the footing is like of this market as you see it after the crazy last few days we've had. What do you think?
It's hard to say, in that I do believe in the underlying strength of the American economy. We have had really tremendous changes in that economy, and the entrepreneurial spirit out here in places like Colorado and across the West is extremely strong. You do have this pro-business administration that's being very helpful to the psyche and everything else. But for gosh sakes, at some point, it does seem that you need somebody who's a thinker, a financial thinker, not a traditional, Goldman banker as our Treasury Secretary, not a president who understands consumer psyche, but not really markets. Somebody's got to look and say, this could go very wrong in a hurry. And that's how it feels to me right now.
All right, Quincy, now interest rates have backed up. We're looking at a 10-year note that's backed up a bit here, a 2-year note that's backed up a bit here, a 30-year that's backed up a bit here. Not alarmingly so, but the S&P has turned negative. The market, which was looking for a while today at a gain of in excess of 300 points, then 200 points, and 150 points, is now up about 43 points. Again, fast market. I don't overanalyze second-by-second moves. I think the 4 p.m. close is good enough for me as a statement on the day. But what do you think of how the markets are going to digest all this?
Well, I mean, it's clear. I mean, it was automatic. The yields started to move up, but also, I think we are in the bottoming process. It's not a one-day event, and what we're going to be looking for, Neil, is the close. Do we see buyers who were desperate to get out sell into that close, or are we going to see buyers continuing to come in to the market? The volatility, the quickness of the market, as you've said, exacerbated by the algorithms moving very quickly, has basically, though, underpinned what we knew was going to happen. This market needed to pull back. It couldn't keep going up every single day, and this is what it did. So this is a process. We think we're toward the end of the process. We'll watch to see how, if money comes in towards the end of the day. If we see profound selling at the end of the day, it is obviously telling you that it is not washed out yet, and there are sellers there who have been waiting. But one thing for our listeners, your listeners, our retail investors, markets go up, but they also go down, and this is healthy. The big question for us now is, does the Fed come to the rescue? We hope not. The market needs to function the way markets work. And that is very important. It's a lesson we need to learn.
Yeah, I hope they don't intervene in this, because they can mask a lot of problems. David Wield, David, I hope I'm not screwing up. Which way do you pronounce it?
It's Wield, but
all right, I apologize.
That's
David.
okay, no problem.
So no, Maney told me that, and it was his fault. No, I'm kidding. But David, I am wondering, finally, your take on this. That do the markets just need an excuse to correct even more than they are? I mean, the president was tweeting earlier today that it's a big mistake when there's so much good news about the economy for them to decline. I'm paraphrasing his earlier tweet. But now, is it constructive when they do react to good news in a good way and react to bad news in a predictably bad way?
Well, I think the first thing to understand is markets are actually structured by human beings, and we put carrots and sticks in different places. This market has become progressively taken the people out of the equation. And so, when you see the activity that happened on Monday, which was for a period of time like a mini flash crash, I mean, really what was happening is we had a snowball effect, a cascade of sell orders that were cutting through what remaining bids were in the market like a knife through butter. And while that's okay in terms of instantaneous corrections, it isn't okay if it gets to the point where it actually undermines consumer confidence, investor confidence, and ultimately small business confidence. I mean, one of the things that we've seen in this market today is it's left behind smaller capitalization companies. The Dow was well outperforming a lot of the micro cap stocks, and the smaller companies is where actually jobs are created, where capital formation is important. The IPO markets have still never come back to what they were in the 80s and the 90s.
Good point.
And we're actually seeing in this country, despite all this entrepreneurial fervor and interest, we're seeing fewer and fewer companies started in the United States. And these things are all interrelated. I mean, we have a market structure that is really not supporting small business, and that is the future. That's what's going to create U.S. competitiveness, tax receipts that are going to fund the Treasury, and ultimately fund a strong military. So we have to really kind of rethink markets on a macro level to make sure that the carrots and the sticks are in the right place.
All right, thank you very, very much. All very wise and prescient insight on all of this.